Investing is buying assets like stocks, bonds, shares, real estate, or commodities with the goal of either selling them at a higher price in the future to make a profit or using the assets to generate passive income for them in the long run. People can invest and manage their investments or hire a professional. Investors can choose to invest passively in things like bonds or buy stocks, which require more work and attention. When people think of investing, the first thing that usually comes to mind is risk. Your strategy will depend on how much risk you are willing to take and how much time and effort you are willing to put in. It may require a change from the way people usually think and act. Because of this, anyone with some money can invest, but they should know what investing is and how it works. Wait until the end of this video, because we will go over these rules in detail to help you understand them better. So let's get started. Rule number 1, change the way you think about money. In the book Rich Dad's Guide to Investing, What the Rich Invest in That the Poor and Middle Class Don't, it is important to switch from thinking like the poor and middle class to thinking like the rich. Go to school, get a good job, work hard, and save money is what poor and middle class parents tell their children. You'll get rich with that. Rich people tell their kids, learn how money works, do good jobs, make money work hard for you, and invest in assets that bring in cash. You'll get rich with that. The poor and middle class think you can get rich by working for a salary. This is one of their biggest mistakes. But because of how the tax code is set up, that is actually very hard to do. Since taxes are taken out of an employee's paycheck before they see it, they are always at a disadvantage in business and investing compared to a business owner. Why is this? Well, money that business owners earn before taxes can be invested. This gives them more money to work with and also lowers their total taxable income. This means they often pay fewer taxes than the poor and middle class. This is a good way to think. They just need to learn how money works or how the rich live their lives. If you want to be wealthy, you must change how you think about money and investments. That starts with realizing that you can make money in more than one way. Rule number 2, know what kind of income you're working for. Most people only care about how much money they can make at a good job. They need to find out there are different ways to make money. Rich Dad taught us for years that there are 3 ways to make money. Ordinary earned income. This is what most people think of when they hear the word make money. This is how much the 9-to-5 crowd makes. Most of the time it comes from a paycheck. It's the hardest way to build wealth because the government takes money out of your paycheck before you even get it, and you're trading your time for your money. How much you can earn depends on how long you can work. You have the least control over your earned income. It's up to your boss who can cut it or fire you. And if you want to make more money, you have to either get a new job or hope that your current employer will decide to pay you more. Portfolio income. Most high-paid employees also have some kind of portfolio income, usually from a 401k and other paper assets like mutual funds or ETFs or index funds. Most of the time, paper assets like stocks, bonds, and mutual funds make up a portfolio's income. It is taxed at the second highest rate and could be better for building wealth because it doesn't bring in much money. Most experts say if you invest for a long time, you can expect your portfolio income to grow by about 7% a year. During that time, there are bound to be big ups and downs. A return of 7% might seem like a lot to someone who doesn't know much about money, but rich people would turn down an investment plan that only promised a return of that much. Your portfolio income is like your earned income because you don't have much say. It depends on how good the stock market goes up and down and how good your advisor is, if you have one. And comparatively speaking, 7% can be seen as quite low, especially in the last 3 years of the bull market, where some investments were averaging 30% per year. Passive income. People with a high financial IQ have a plan for investing that aims to create passive income. Most of the time, real estate, royalties, and business distributions are passive income sources. Passive income is money you can get from something you don't have to work for. You can get money from the sales of your books. They are cash flowing assets that make money for you while you sleep. How awesome is that? You also have passive income if you own a business that sends you money. In short, you get money whether you work or not. Income is taxed the least and has the most tax breaks. It is also the easiest way to build wealth because it is taxed the least and can return an infinite amount. If you want to be rich, work for passive income. And I personally couldn't agree more. Rule number 3, turn regular income into passive income. Most people start by getting a regular job and making money. The first step to getting rich is to realize that there are other ways to make money and turn your earned income into those different ways of making money as quickly as possible. There are several ways to turn regular income into passive income, including investing in dividend-paying stocks or mutual funds. This allows you to earn money from your investments without actively managing them. Renting out a property you own, such as a house or apartment. This generates income through rental payments. Creating and selling a digital product such as an ebook or online course. This generates income without requiring ongoing effort. Creating a business or investing in a business that generates passive income such as a vending machine or ATM machine. Investing in peer-to-peer lending allows you to earn interest on loans you make to individuals or businesses. It's important to note that some effort is often required to set up and maintain these passive income streams, but once established, they can generate income with minimal ongoing effort. Rule number 4, the investor is either an asset or a liability. Many people think it's risky to invest. The truth is, though, that the investor is the risky one. The investor is either a good thing or a bad thing. Rich Dad said, "I've seen investors lose money when everyone else was making it. In fact, a good investor loves to follow in the footsteps of a risky investor because that's where the real deals are." This means how much you know about money can either help you or hurt you. If you know very little about money but still want to make big investments, you will make many mistakes that investors with a high financial IQ will use to their advantage. If you are a risky investor and want to become a good investor, you should first invest in your financial education. As a way to learn, because nothing beats real-world experience, start with small investments, learn from your mistakes, and then make bigger and bigger investments. And rule number 5, good deals bring in money. As a new investor, one of your biggest worries is how you would get money if you found a good deal. It is your job to keep in mind the opportunities in front of you and be ready. If you're ready, which means you're educated and have experience, and you find a good deal, the money will find you or you'll find the money. Finding a good deal that attracts money is hard, which is why so many people are willing to give money to a good investor. Other people's money, or opium, is what it's called, and it's worth learning more about. Rule number 6, learn how to weigh risk and reward. Risk and reward are two important factors to consider when making any investment or business decision. Risk refers to the potential for loss or failure, while reward refers to the potential for gain or success. It is important to weigh the potential risk and reward before making any decision. Here are some tips for weighing risk and reward. Number 1, understand each option's potential risks and rewards. Research the potential risks and rewards of each option you are considering. Understand the likelihood of success and failure and the potential magnitude of those outcomes. Consider the time horizon. Investing for the long term allows you to ride out short-term market fluctuations and gives you more time to recover from any losses. Number 3, diversify your portfolio. Diversification is the practice of spreading your investments across different types of assets and industries. This can help to reduce risk and increase the potential reward. Number 4, have a plan for managing risk. Develop a plan for managing risk, such as setting stop-loss orders or taking profits at predetermined levels. Number 5, be prepared to adjust your strategy. Be prepared to adjust your strategy as needed based on changing market conditions and new information. It is important to remember that there is no such thing as a risk-free investment, and every investment involves some degree of risk. Even not investing involves risk because you lose up to 8 to 9% a year with inflation at its current rate. With due care and attention, you can weigh the risks and rewards of your investment and make informed decisions accordingly. Mastering these 6 basic rules of investing will help set you up for success. Remember, investing is a long-term game, and it's important to stay disciplined, diversified, and patient. With these tips in mind, you'll be well on your way to financial success. Thank you for watching. Don't forget to subscribe to this channel for great content on investing and personal finance.